Hey everyone, Couch Investor back to another video for today. So I'm going to try and be a bit more positive because you've probably seen all those headlines and articles, maybe videos as well, talking about the incoming stock market crash or maybe the crash of the US dollar. Now that actually might happen in the future if a couple of things don't change, but that's maybe a topic for another video. But in this one, I just want to show you the graphs for the S&P 500, maybe the Nasdaq as well, and see what happened in the last couple of months, in the last couple of times that we had a little correction. Now, most small to medium stocks, most growth stocks have already corrected. Maybe they will correct even more, but to say that nothing has happened in the last couple of months is just a plain lie. Yes, those big ones, those $1 trillion clubs, stocks have always gone up, and that's what's taking actually the market over new all-time highs maybe each and every week for the last couple of months. But I'll show you right now in the graph that the S&P 500 actually has had the same type of corrections for the last couple of times. We can see it all the way back in May when we had that market correction. It dropped and touched that 50-day moving average. The same happened in June, same happened in July, 3% correction, then 2%. And then actually at the beginning of September all the way to the beginning of October, we had a 5.2%, let's call it a little crash, that actually went under the 50-day moving average. That's the green line here. And then right now, today, we are down 2.74% and we're just near that 50-day moving average. Now, if we look at the RSI and the MFI, we can see that we're not overbought anymore. We're actually going on our way down to being more neutral, and maybe over time, if we do break that 50-day moving average and maybe touch on that 200 one, then we might start being oversold. Now, if you want to know what the RSI and MFI are, I have the definition right here. So the RSI has become very popular amongst traders and technical analysts. Typically charted over a 14-day look-back period, the RSI is both range-bound and smoothed, making interpretation straightforward and easy to combine with other indicators. The basic building blocks of the RSI formula are the average gains and average losses within a security's price changes. Now for the MFI, on the other hand, it uses typical price and compares it with several different evaluations of money flows in and out of the security. Based on the theory that volume precedes price, the MFI acts as a more ambitious leading indicator than the RSI. Notably, 14-day periods are also the default with the MFI. Now, if we're looking at the Nasdaq right now, it's also down 3.3% from its all-time highs and very, very close to that 50-day moving average. And basically, if you put this chart and the S&P one, it's very, very similar. When one drops, when one rebounds, the other does the same thing. Besides what happened here in May, we've seen with the S&P one, in May it rebounded off that 50-day moving average, and with the Nasdaq that did not happen very quickly. Now, obviously, I'm not saying things cannot go lower. I'm very okay with a crash coming, that way valuations get slashed even more. Just saying that if we're looking at past performances, we can see that right now, close to that 50-day moving average, we've seen a rebound happening, and with us coming to the end of this year, maybe we might see the market wanting to close the year on a strong foot and then start the next one as well with a strong momentum. Now, obviously, we need to take something else into consideration, and that's this new variant. As of now, I really don't think we know that much on that subject. I think it's lots of headlines, lots of fear mongering, lots of just articles popping left and right. So you click on it and they get some money from advertisers. I think what's going to happen right now, because it's winter, flu is coming back, etc., we'll see more and more of those headlines, but don't let them trick you. Now, before we finish, let's go and look at some of the small, medium and large stocks that have taken a hit already. All right, so we're here in the magical world of Excel. So the ranking here goes from most down since all-time highs to not that much. So we see here Netflix, Etsy, Apple, the big guys are not down that much from their all-time highs. And that's maybe completely normal because their valuation, their multiples weren't that high either. Maybe Etsy, I don't know how it's so high right now, but let's give them that. But if we go back up, I've categorized them from COVID stocks, reopening ones, neutral, e-commerce and cashless future, and then advertising. Obviously, there are some other stocks there, but for the sake of discussion, let's keep it as simple as possible. Now, if you take a look here, you can see that stocks that are down 40% or more are coming from various categories. Obviously, COVID stocks got hit the hardest because, well, everybody thinks nobody's going to use those products anymore. But as you can see, a lot of stocks are down immensely since their all-time highs. Now, that does not mean that those stocks are cheap right now. It just means that we already had a big correction with those high-flying COVID stocks and just stocks that went super high during that period of time in 2020 and at the start of 2021. So to say that the markets are at all-time highs right now is correct, but you need to look further. It's fun to see the Nasdaq, the S&P at all-time highs, but you need to look a little bit further and you'll find that stocks are already down 50, 60, 40% from their all-time highs. Now again, that does not mean that those stocks are certainly cheap right now, but it does mean that we've seen a correction happening. Now, we might see a correction continue to happen because yes, even right now, some of these stocks are still expensive. But to say that the market has not corrected yet is just plainly false. So to conclude, if you want to play this safe, just have a cash pile on hand if it drops even more. And if not, just continue to dollar cost average. Over the long term, I really don't see a huge recession happening that will last years and years. But if a market crash does happen, it will happen very fast, as we've seen in March last year. It lasted a month or so, and then we started with the rebound already. So do have some cash on the side. That's always a good option. Yes, I know cash is trash, but in these types of cases, cash is certainly very useful. So that will be it for this video. Let me know down in the comments below what your plans and maybe doomsday scenarios are for the upcoming market crashes or not market crashes. Let me know down in the comments below. And if you like this video, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button. As always guys, take care, stay safe, and see you all in the next video. Bye bye.